As we're doing this, that we're breaking the last support in the market, the lowest level that we just had, the last form of support we had. So it's really getting spicy now.
Oh, it's it's definitely been spicy. Everybody that's hopefully starting to see this, give me a second. I want to make sure that it's streaming live appropriately on all the various platforms. This is going to be a good conversation and very well timed, because if you haven't noticed, things are getting a little spicy, volatile in markets. Will and I have been communicating and coordinating and lamenting and being excited all at the same time. I think Todd's in the same boat. Volatility brings opportunities, and this could bring a pretty big one. So certainly appreciate the environment that we're coming up here. Those that are watching this, whether it's on the GraniteShares handles, the Lead Lag Report handles, or the Todd Akin's handle, or my Alexa going off here, we can see your comments. Okay, so as we're live, if any of you want to engage during this roughly 50-minute conversation, don't hesitate to post on whatever platform you're on. We'll kind of riff, bring it on stream. Let's make this as interactive as possible. So Todd, hopefully you got some of your fans also asking questions. I see some comments already on the YouTube side coming in. Which is good, right?
I can also post it to Discord and let people know. Do I just tell them to find me on YouTube?
Yeah, if you want to do that while we're doing this initial intro, why not? It's like the beauty of being live is we're doing this stuff all on the fly.
Absolutely. I just tell them I'm live right now. I can't see my feed on YouTube, but I just tell them.
Yeah, it's there. It's there.
Okay. All right.
So everybody, just by way of some context, my name is Michael Guy. This is the High Conviction Podcast by GraniteShares. My co-host, friend, and of course the founder of GraniteShares, Mr. Will Rind, is going to be a big driver of the conversation. So, Will, I think you should introduce yourself.
Thank you. Well, good afternoon, everybody. Will Rind, founder and CEO of GraniteShares. For those of you that don't know us or not familiar with us, we're an ETF issuer. So we create ETFs, list them on the stock exchange, and market them. We have a broad offering based here in the United States, also in Europe as well, and presence in Asia. So the firm has been around about 7 years. We manage about 8 billion, although that seems to sort of shrink by the day with the tariff and the volatility that we're seeing in the market. But great to be in this conversation.
By the way, I shouldn't be laughing at that, because I know that it's like, to go from like 10 billion to 2 billion because of this insanity is obviously not a fun experience. Yeah. But you've been around for a while.
It's the old saying is, if you can't laugh, you'll cry. So
believe me, I know that fully. And then, of course, our guest is Mr. Todd Akin, who's got a solid YouTube following. We're going to actually see him in person in Vegas in a couple of weeks here. But Todd, for those who don't know your background, since there's a large number of people watching this who may not be familiar with you, who are you? What have you done throughout your career? What are you doing now? Give us some context.
Well, thanks for having me, guys. And I appreciate what you're saying too, Will, because we're all going through it. So that made me feel a lot better. I appreciate that. I've been investing for about 20 years. I was doing trading for 10 or so. I graduated with a finance degree, U of H and all that, but it didn't teach me much about finance, so I was doing trading for 10 years, doing well, beating the indexes, but that didn't give me qualifying income to the banks for loans to live free away from a 9-to-5. So that's when I had my epiphany of sorts to go away from the U-Pros of the world, the SSOs or whatever, the leveraged index ETFs, and go towards dividend paying ETFs. But the catch was that they had to be indexed, otherwise, you have a lot more volatility. And then I used the margin because I asked my banker if this would show up on a credit check, and he said no. And I needed to engineer this income fast because I had my son, TJ, who's in the background over there. And so I had to get a house for him. And so I needed dividends. I needed to engineer my dividends fast. So I did it with margin. And then the whole thing just kind of snowballed from there because I had to figure out how to use it properly. And then and then I started a YouTube channel just to share, spread the word about dividend investing, but with a little bit of leverage, to live free.
Can I ask you before we get too deep into things real quick? Are you big into looking at space? The telescope in the background. I feel like there's some story there.
Oh yeah. I mean, before they built up this little neighborhood right here, you could see, you had a great view, 360 degrees from here. But I like stars, but this is not as high quality as I would like. But yeah, I mean, I'm glad you caught that. Yeah, because it's a little hobby of mine, sure.
So I guess it begs the obvious question: are you living free from the 9 to 5?
Well, I think so. I mean, all of my bills are automated out of my brokerage account, my E-Trade account. So I just live out of that. My dividends pay back my margin leverage so fast. We earn, I don't. You can see my channel, of course, but we earn a sizable amount of income. Thanks to GraniteShares, thanks to these new funds out there. So that just pays down the margin so fast. It kind of takes the risk away, and then you keep growing your income with more margin leverage. But again, if you do it properly, you have to watch your maintenance and all this kind of stuff. And so that's how I live. I just live out of my equity and my brokerage account. I swipe my E-Trade card and I can go wherever I want with it. I always say.
Awesome. So how would you sort of characterize the environment for dividend or yield investing at the moment? Or I guess maybe let's say this year.
Well, I appreciate that question because dividend stocks and certain dividend ETFs have been doing really well during the recent correction. Like staples have been up, they've been on fire. I've been pounding the table about buying blue chip staple stocks, to offset some of these technology related dividend funds that everyone's, become so well accustomed with. They're falling in love with that, and they're getting a little too head over heels with them in some cases. So these have been acting really well, these dividend defensive names, which Kramer just came out a couple of days ago saying he liked him, which made me nervous that the trend was topping out. And in the last 2 days, we've had staples cool off, tech rally, and maybe there's signs of you could maybe look at signs of a bottom there. We're around the 200-day moving average. So dividends have been not only my favorite theme for investing for the last 10 or so years or whatever, 20 years of investing, but dividends about half of that. But now you have all these new funds coming out, and I just think regardless of any environment out there, GraniteShares, all those funds that have come out recently with these new indexed vehicles, I think that they're just a great time to buy, especially when the indexes have fallen. But even if the indexes are higher and they're moving higher, I still keep buying these funds because it's important to stay invested in the S&P at all times and the indexes at all times. If you can get a dividend, then even better.
You mentioned that you do some options. How did you get into options, and what's that sort of journey been like?
Well, that's what I thought your funds were so interesting for, because of the new, YieldBOOST ETFs that, Michael was explaining them to me, so well the other day, which is, how y'all sell puts, correct, on, the indexes, on the leveraged indexes, which is what I sell puts on. But I always wanted someone to do it for me. And so there we go.
There you go. Yeah, no, that's the sort of the secret sauce, if you will, about YieldBOOST, is that the idea is that when you sell an option on a stock, clearly there's an implied volatility. You sell an option on any asset that's unleveraged, you've got a certain implied volatility. And then if you sell an option on an asset that's leveraged, you have potentially 2x or 3x the implied volatility. So you just have a lot more premium to play with if you're a seller of volatility. So that's the secret sauce, is that you get more yield, all things being equal, or more distribution, more premium from that, because you're arbitraging that difference between the unlevered and levered options.
Absolutely. And I don't really see the risk in them because the higher premiums you get from them they lower your cost basis, and they lower your break-even point because they're higher premiums that you're getting. And so a lot of people would call me crazy for selling put options on those because they would lower my margin significantly. You sell the puts, you get a few thousand in premiums, they lower your margin so fast. And then you're still getting index performance because they move up with the market still, just not at the same rate of volatility. I would do leaps in my case so I could get more premiums. I go all the way out, furthest out you could go, get the most premiums, lower my cost basis. And a lot of people say, why do you do that? Do it more short term. Well, I'm not as skilled. And, that's again where I'm sure you would come in and be able to manage that side of things a lot better,
Yeah, it's interesting. And then just gonna say one thing on the risk side is that clearly you can these things can swing around quite a bit because of the volatility. But what we actually do, in addition to selling puts and generate that premium, was we buy puts as well. So we actually have a put spread. We buy the out of the money put to try and give some protection against those extreme downside moves, which is what clearly the main complaint with any covered call or options based, well, any yield strategy, I should say, but particularly on the option side, you see a lot of people going on about, yeah, yield's amazing, but big amount of NAV decay.
Right.
And that's because there's typically no protection at all from the downside. So that's what we try and do, is offer some of that.
Yeah, and I don't know if what you think about NAV decay, personally, because the NAVs fall, the charts fall, but you factor back in the dividends and you have a much different return.
It's really interesting because the numbers obviously make the difference. And if you're talking about the annualized distribution we just made on TSYY, which is our Tesla linked YieldBOOST ETF, was just over 160%. So the annualized distribution 160%. So clearly, the underlying have to fall by a crazy amount in order for that to be anything less other than a decent return. So it's really interesting because when you start thinking about income first or distribution first rather than capital growth, you're sort of flipping the argument and then saying, well, okay, if I'm making X amount on the income, as long as my principal doesn't fall by Y, then I'm still making a better total return than if I just put the money in the market and it went up by 10%. So
Right.
it's these relative numbers that you play with, but it's just a reframing of where you get your return.
Yeah, and I love I'm not trying to sound so optimistic about your funds, but like I have a horse in this race. I buy all the funds, but I love the dividends I got from TSYY. Like the other day I got that dividend, in my inbox.
Yep.
And it was substantial. I was like, oh, and I have a small position in TSYY because it's more stock related compared to the indexes,
Yeah.
and it was still really nice.
Yeah,
Offsetting a lot of that volatility.
No, absolutely. I think the game with all of these things is you have different income streams. So therefore you have diversification of where you're getting your income from, and or, for the folks, another way to look at it, which is, for the folks that love, the capital growth, but they still want some income, which,
Right.
in essence is the essence of investing at some level, is that you got instruments for both. If you want that pure capital growth, you have plenty of ETFs that deliver pure capital growth, and then if you've got income needs, you've got plenty of ETFs that are able to deliver that income and also deliver diversified income.
I totally agree.
So I think it's interesting from a lot of perspectives. Obviously, you come from the retail side versus the product side, like GraniteShares, right? And I find it amazing that there's been such this sort of grassroots demand for yield as opposed to just capital appreciation, right?
Right.
Typically, when you think about retail and trading, you think about momentum, making $10 on a stock. You're not thinking about the dividend or distribution yield at all. Right. But really, that changed the last several years. I'm curious if you have any thoughts on sort of why the psychology shifted towards wanting very high yield. Is the simplest answer the right one, which is that inflation's high, incomes are not keeping up, so you got to get it from your portfolio holdings, or was there something else that was like a catalyst for this demand out there?
Well, I think that's a great question. I mean, yeah, I think it's part of what you said. Inflation and cost of living is so high, and people wanting to explore, not having to work a job, maybe alternatives with dividend, income streams and stuff. And I think that's definitely a part of it. One of the interviews I was on, a Bloomberg podcast, Joel Weber, I think his name was, he was saying that there's been legal changes with the way that you can invest in some of these ETFs, and they think there's a lot of erosion happening. And I thought, again, that was sort of a myth. You go look at total returns and you kind of see otherwise. But so I was kind of surprised by that. But I think that it's a combination of the legal changes combined with the fact that your dividends are real when the IV is that high. So if the IV is 60 for Tesla, then the dividend is 60. It's pretty simple. And I don't know why a lot of people can't, understand that. But but because of that, more funds started becoming, issued. And, because the volatility is so high, and that just naturally becomes, it's the Mag 7 names, the top index names. So you had a best of both worlds. It was like almost hitting the trifecta for investors. You get the growth, you get the dividends, you're indexed largely with a lot of them. Tesla is a big part of the index. So I think it was a confluence of all those factors right there.
Did you, I guess, when you started to get into this, what was your, I suppose, journey that led you to where you're like, what did you start doing income wise? What was the first sort of things you bought?
Thank you so much for asking that, because Will, have you met Jay Hatfield?
I have not met him personally, but I know who you're talking about.
I was wondering if your worlds ever, crossed.
It's funny. I know someone that works for him, so I'm familiar with the person and who you're talking about.
Yeah, well, he taught me about leverage with his income funds. I was writing for Seeking Alpha, just doing some, articles here and there, and I was doing the energy space, and I had to get more. I had to buy more conservative assets at that time because energy was really imploding, and so I went to the pipelines, because they're more conservative, and I was really getting heavy into one of his funds that was pipeline related, and it had a little bit of leverage and it had a little bit of an extra dividend. So that's what drew me and a lot of people to it at the time. And he just wanted to make sure that I was explaining it properly. So he would mentor me some on how these funds work with leverage. And then he started seeing my approach with margin and taught me about PFFA, like preferred shares, preferred, and how they move very sideways. They don't move much at all, preferred shares. And it had about a 7% yield. So I started out with that, that and AMSA, because preferred was more diverse. PFFA was more diversified. It was a different asset class, preferred shares. So it was kind of sexy. It wasn't, just, your typical stocks and bonds or whatever. And I did that for a while, but the problem with that was the income was too low. And also preferred shares will still crash in a Corona style crash, and they won't protect you during a real crash. So I realized if they're all going to crash, then you need to just stick with the indexes first of all, but go with the highest dividends that I can go for that are safe and actually have the real dividends behind them, like the right IV behind them, or they're indexed, like 15-20% dividend with some of these indexed funds. So I made sure to do that. And it really limited my drawdowns, because the funds that he had major drawdowns, during Corona. And I have nothing bad to say about anyone's funds. It's really all about, the whole market takes everything down with it. Rising tide raises all ships and all.
Yeah.
And so that's how I got into it. Yeah, right. And so he's the one who taught me how to use leverage without the volatility through preferreds. Then I realized that there are still some holes in that strategy. Then I kind of, really ironed the kinks out during Corona, and I found index funds with nicer dividends, mostly closed-end funds, which are kind of different. They're a different animal because they have rights offerings. You have to play them a certain way, and that's what a lot of my channel talks about. But then, we have, GraniteShares and these other kinds of ETFs to the rescue, where they're not CEFs, they're not closed-end funds, they're just ETFs. They're straightforward, and they're the index, and you get the dividend yields. And now it's made investing so much easier.
Did you ever play with or did you ever invest in BDCs or any of the other sort of pass-through securities?
Yeah, absolutely.
Yeah.
I went for all the BDCs, CLOs, any type of
everything.
Yeah, I was buying them all under the sun and trying to spread them out to be like 1 or 2% of the portfolio, so not one would take me down. After Corona, I learned, that they're gonna. If I had just 20% in real estate, but they were leveraged real estate ETFs, ETNs actually, which are terrible when they have the accelerator clause when the market's falling, and so I just like straightforward ETFs, for that reason.
Can we? I want to take a step back for a second.
Yeah.
You're extremely knowledgeable, right?
Thank you.
And I say that I can tell from the way you're speaking, the way you're thinking, and your line of thinking. How'd you get to this place? I mean, if you're saying you didn't really learn about it from college, How did you learn to get to this point?
Yeah, man, this has been a great podcast. Just, because, Will,
We're so early, man. We got 6,500 people watching. Come on. Yeah,
I just really appreciate it. I mean, because, finance is a topic that a lot of people don't want to talk to us about in our personal lives, so it's just great to talk to y'all about this stuff in a safe space. So what made me get here was, first of all, I crashed and burned a few times with energy. When energy crashed, I lost it all. And I had to reinvent myself. And then I was doing well, and I found these dividends. That's kind of the transition from energy stocks to then pipelines with safer earnings, and then the crash with then you had the energy crash, but then you also had the Corona crash, which brought it all down so much. And I realized you can't have so much in energy and real estate. Yeah, those are only 3% of the index, 3% of the index. You have to keep it in. Well, first of all, tech is 30 to 50%, however you want to look at the index. You have to keep it in the indexes and keep those up high, and then the riskier sectors and stocks down low. And it was all through necessity. Like necessity is the mother of all invention or whatever. And I would just lose, and I was determined to not go back to a job. I've had many jobs. I worked quite a few, and I just always felt like, I wasn't living my passion, living free. I knew I had a lot of knowledge with stocks, but still wasn't able to live free with that either. Not quite. I was ironing out all those kinks until we found just go with the indexes. I had a college professor who was in history. He was my government teacher, not even finance. He told me stay with the indexes. He wrote for the Houston Chronicle, and he said, listen, whatever you're saying, Todd, you know all the tricks. You think you know everything, but just buy the indexes, like Warren Buffett says. And that just turned out to be true. And that's what got me here.
So as an extension of that, so you have the experience, the knowledge, the self-learning, and then you built out this YouTube channel, and then you got the Discord group. I have never for the life of me understood how Discord works. And maybe this is me just being older, right?
Really?
I don't know. I think it's confusing personally. But
me too.
Okay, so I'm not that crazy. So, but like you built a little bit of a nice community, right, of traders. So, who are these people? How are these people even finding you?
Yeah. Discord all came out of just raw demand for the channel. Obviously, people have a lot of questions, so I direct them to certain literature that I have. And then after they read all of my guides or whatever, and just read, just they follow my portfolio. I have services where they can call me and they can look at what I have and just mirror what I have or whatever. Once that happened, they just wanted a place to go talk about it all in one place. So they started Discord for that. And then that was to give alerts for the rights offerings for some of these closed-end funds, Cornerstone being obviously the big thing that I always talk about, but I buy all the funds, and I put them on Discord, and we share that in Discord. And we have all these other channels. We started again. I brought this up to y'all. I wanted honestly this podcast to be the unveiling of the next channel that we put in Discord, which is that GraniteShares channel. And we can now all talk about these ETFs as they come out.
Did you learn a lot of stuff from Seeking Alpha? I know you mentioned it earlier, and I bring that up because if you write on there, my assumption would be that you also kind of got a lot of information, and Mr. Guyad as well knows a little bit about Seeking Alpha every now and
again. Seeking Alpha, I like their resources to look at like the comments below an article. That's where I get all of my information from. The articles might as well, the only thing I look for in the articles is in those top bulleted points is if there's some sort of balance sheet issue. If there's nothing like an accounting error or a balance sheet issue or some sort of earnings, like we're talking not a one-off, but a major change in earnings.
Major corporate action or something.
Right. Then I never listen to anyone's opinion on Seeking Alpha or anywhere for that matter. You just buy the lows, sell the highs. You don't listen to any of the noise. And I read the comments to see if anyone around the area might have known something more, intimate about the company. And that's where I get all of my information. It's just from the comments. And I basically see if everyone's negative, that's when I go positive. When everyone's positive, I tend to go negative. And but they're just I check them out when I need to do a quick scan of things. When I was writing, I just wrote what I would, scour the earnings calls with. I would get information from these earnings calls, and I just share those details because I know a lot of people don't want to dig into those.
By the way, I love that. Sometimes the what matters is not the article, but the comments under the article.
Yeah.
I used to be one of MarketWatch.com's top writers from like 2013 to 2016.
Okay.
I get like hundreds of thousands of page views, and I tend to make calls. I've kind of softened that over time as it's more about conditions than mile markers. But whenever I would make some kind of dramatic sounding contrarian call, and I would see the comments that were most vitriolic made me more convinced I was right.
Right.
To your point, it's a sentiment indicator. It's a contrarian sentiment indicator.
Especially the vitriolic comments when they have nothing to do with the content, just they want to go at, how you presented it or how they feel about something. Right. That's when you really know you're on the right track, I think.
Yeah. There's a question, maybe a couple of questions.
Yeah, and actually, it's a good plug for GraniteShares, but somebody's asking, well, what is GraniteShares? I think it's a good opportunity for you, Will.
Yeah, someone joined late. Didn't hear the introduction.
Right.
Yeah, we're an ETF issuer, so asset manager that specializes in ETFs.
All right, let's see if we can go through some here.
We can pick up some near the end. I think
yeah.
I wanted to come back to this idea of, I think probably the biggest question right now for investors is,
Hulk, thank you, Hulk.
You got Hulk Hogan saying, I didn't know you had Hulk Hogan that's a fan of yours. That's great.
Yeah,
there you go.
Hulk is great. He always has great vibes. Always appreciate Hulk. And he's also a savvy investor. You're asking, who are these investors? I forgot to answer that question. I think that most are honestly in their retirement, phase, or they're just trying to be retired. But I found just from my analytics at YouTube, most are in their 50s, 60s, 70s, I want to say. But I think that they all have this insatiable appetite to live free too, and or at least I'm not against jobs or anything. Use your job to supercharge your returns. You know what I mean? Either one.
That's a good quote, by the way. I'm not against jobs.
Right. I because I don't, that tends to be a polarizing comment. So I think that they can just make you even stronger. Obviously, extra income from a job and dividends. Have a question.
Yeah, I think, Will, you were, sorry, I interrupted you, Will, I think with your train of thought.
Yeah, so I didn't want to get too off track, but I think, the biggest question right now is clearly what's been going on in the market this year and all the volatility that we've been seeing. So, question that goes to the trade policy, tariffs, et cetera. And, Todd, does that change in any way your style, your investing philosophy? Does it cause you any concern? How are you kind of thinking about this environment?
I appreciate that. Just because we know that we're dividend investors, and we only care about collecting our income. So for you to ask my opinion on just the state of the market in general, I appreciate that. Yeah, he had tariffs before and the market went up, so that's one thing I look at. But honestly, I've been looking into these to each individual tariff, and I understand the ramifications of them, but it seems to me like GDP is so strong, like still around 2 to 3, and unemployment, employment is still high, unemployment is still low. Inflation has not been going higher according to the numbers we got recently. I don't know if there's, they say there's always a lagging effect, but I look at it all as noise. And really, if you look at the price action, now you had tech correcting, expensive names correcting, the cheaper names going back up in value, like the blue chips that we were mentioning earlier in this podcast. And so it looks like nothing more than a sector rotation from really expensive, stocks to the cheaper stocks. Even Costco and Walmart, which are top weightings of the XLP, they did not rally recently because they were so expensive, and they kind of corrected because the expensive stocks are correcting. Even
hold on, you're telling me that a hot dog doesn't justify a P of 50?
Right.
Is that what you're saying?
Yeah, exactly. Like They're getting up there. They're getting pricey, but I noticed that, there's a lot of overlap between the XLP and then Costco and the NASDAQ. It's one of the top 10 holdings of the NASDAQ. And so, yeah, no, I get your point totally, Michael. And and just so these expensive stocks corrected and these cheaper stocks, caught up in value. To me, it looked like it was nothing more than that. Real estate was up too, aerospace and defense, healthcare, staples. So.
Let's get some questions because some of these are actually pretty good. Those that are watching, by the way, again, we're live. So if you want to ask a question, type it in now.
Yeah.
We'll try and bring it up. This is a good one, actually. And it's one that I've talked about also with other guests, with Will in the past. Does the steady increase in 0DTE options as a total of option volume concern or excite you? So given, Todd, that you've done a lot of work on the selling of option side yourself, what's your take on 0DTEs?
Well, Denali, I appreciate Denali. I know Denali. He's obviously in my members group. He always has a lot of great ideas. Well, I like 0DTE because when they expire, you're getting some sort of premium, and a lot of times, like the Defiance funds that we're in, they have their 0DTE. They will fall less in the market on a down day. They're collecting some sort of premium. So I think 0DTE, when it's tied to the index, to where if they were to get assigned, even though the options, I believe, are European, so if they can renegotiate that assignment, but if they were, it would just be the risk of owning the index itself. So the risk of the underlying is not there, in my opinion, Denali. So if it's just 0DTE, I know that's a fancy word or whatever, but honestly, to me, that just means it's expiring and they're going to collect some premiums that day. And Will, do you always, I'm not too experienced in this field, do you always collect some premium in that field, or can there be days where you don't get any premium?
I guess it could completely depend on the applied volatility at that time. But, I sort of come down on this argument as being generally in favor of more liquidity. So I understand potentially what's implied by the concern element to the question. And I guess the concern element is, okay, if there's more people trading 0DTE, and if 0DTE is sort of tantamount to speculative activity, if there's more speculative activity going on, is that a concern from the market? And I sort of fall down more on the argument that creates more liquidity, regardless of whether it's speculative or not. And more liquidity, I think, all things being equal, has to be better for the market. It's certainly better for me, selfishly, as a product creator, because new strategies can be developed when the market has more liquidity. And you have, for example, something nothing to do with us, of course, but you have the first sort of private credit or private credit light ETFs kind of launching in the market. And those are just simply not possible without liquidity. And as we sort of grow in liquidity in all different aspects of the market, then more of these strategies become unavailable and therefore become unlocked to investors. And I think that just makes for a more robust capital market structure more broadly.
That's a great point too, about when more liquidity is present, you can issue more of these funds and stuff, and also Denali, Will, I think you cleared up that point pretty well, in my opinion, which is it just brings more liquidity. But I think a lot of my viewers are under the assumption that you can trade, let's say, a TSYY and affect it. It's all about the underlying, you're not going to really affect,
Yeah.
the
dude, you are so smart. Thank you. I'm not gonna gush over this, but you legit know your shit. I'm sorry to curse, but listen, I deal with a lot of advisors, and a lot of advisors don't even understand that point.
Right. I mean, I've understood. I don't understand why they don't get the volatility issue, the decay. You derive the dividends from the IV. Pretty simple. The decay, you just factor back in dividends. You factor back in returns for dividends. And then for the underlying, you can't mess with the vehicle. It's about the underlying that would really affect your risk in the investment. And those are the three biggest disconnects I see.
And by the way, within that, as Michael said, the probably to this day, still, honestly, the biggest disconnect with ETFs, just I don't care what ETF it is this idea that if you have, a few thousand shares or a few hundred shares, whatever, trading, that it's not liquid. That is still something that people just cannot get their heads around, because they're looking at it purely with the stock investor's brain, where that absolutely is the mantra, because you can't create more shares of Apple, just on demand if you want to. Whereas with ETFs, because they're open-ended, of course, that's the whole point. You can expand and contract the amount of shares outstanding, according to supply and demand of the market. So as long as the underlying is liquid, that's the big caveat, of which it should be if it's an ETF. Then the amount of shares that trade is not correlated. And for people that are worried about that, there's also different order types that can be entered to try and mitigate that, where you can enter a limit order clearly if you have concerns about the amount of shares that are trading on the market at a given time. But it's interesting.
That's another big one right there. Definitely that disconnect.
It's another Go, Todd. Go. Sorry. Yeah.
Well, I mean, it was just important for him to clear, because these four that we've addressed, these myths or disconnects need to be talked about, I think.
Well, part of what we're trying to do with the High Conviction podcast is obviously educate, right, from an issuer perspective, which I think is great. Why you being here and providing color too. Will, this one's for you from Aaron. I hope I pronounced that right. Can you explain the difference between the category of your income ETFs like HIPS versus YieldBOOST?
Yeah, so I'll try and keep this relatively short, because we could talk for a long time about it. So they're totally different types of ways to generate income. So HIPS is an ETF that we have. The acronym stands for High Income Pass-Through Securities. So this goes back to what Todd was saying earlier. HIPS is a portfolio of pass-throughs, and the four main sectors are MLPs, BDCs, REITs, and closed-end funds. So what do those things have in common? None of them pay corporation tax. They're all, as the name suggests, pass-through entities that take whatever their income is, their revenue is, and they pass substantially all of that revenue through to the shareholders directly without any kind of corporation tax. So HIPS is an investment that just buys, it's actually an equally weighted portfolio of pass-through securities, and it pays a fixed cash distribution, 10.75 cents per share, which is like $1.29 of income per annum on a basket of pass-throughs. So there's no options involved in that. It's just a straightforward strategy to buy high income generating investments, diversify them across sector, and pay a fixed cash distribution. So you can lock in that yield when you buy because of it. That's the unique part. But it's been around for 10 years. So we've done 10 years worth of monthly distributions, same distribution every month, never faltered, even through COVID. So that's an interesting strategy. Now that compares, or that's very different to YieldBOOST, where YieldBOOST is purely about options generated income or options generated yield. So YieldBOOST is a family where it's a mixture of both individual and diversified underlyings, where the strategy is to sell put options and generate a very high level of yield, and in concert with that, buy put options to try and protect against the downside, or certainly the extreme elements of downside movements. And the twist on YieldBOOST is that YieldBOOST is able to pay these really high yields, like, for example, the annualized yield on TSYY, which is the Tesla one, which we paid at the end of February, was just over 160% annualized. And we're able to do that because the options that we're selling are actually options on underlying leveraged ETFs. So be it leveraged single stock ETFs or leveraged index-based ETFs. And as Todd was saying around the implied volatility, the reason for doing it with leveraged options is that you get 2 times, 3 times the implied volatility, depending on which option is being used and which underlying it's referencing. So you have a huge amount of premium, which allows you to not only distribute a large amount of income, but it allows you also the money to pay for that put option in the put spread, as we call it, to try and protect against some of the downside movements or the extreme downside movements. So yeah, just a different, two different styles. And as we think about income investing, just as Todd's been talking about, this is why we wanted to have him on the podcast, because there's all sorts of different flavors. If income is like ice cream, there's all sorts of different flavors. And it's not that one is right and one is wrong. It's just whatever works for you, whatever you're comfortable with, whatever you understand. But they're just different ways of incorporating income into your portfolio.
Let's keep going with some of these questions from Jose on LinkedIn. All dividend options or whatever instrument we use to capture premiums, we only gain nominally. Correct. Money illusion is real. People don't realize that after inflation is very different than before. My question for Todd is, are you exposed to any assets that hedge against the devaluation in the US dollar?
Okay. Yeah. Normally. Okay. Any assets that hedge against the devaluation of the US dollar. I mean, I try not to worry about currencies, as a whole. I need a lot of income, enough to change my lifestyle. And, you can look into the old dynamics. Like, I know that you can say that there's the correlations, the dollar up and, some used to say dollar up, oil down, or, dollar up, sometimes market down, because this is a bad thing for, exports or whatever. They kind of, in finance, the one thing I learned from my degree is that when you get in the currency side of things, they get so muddled. It gets so confusing. I don't know how people honestly do that, and game that all the time. But I just live off the dividends passively, and I hedge my portfolio as a whole. If there's a big dollar, issue and there's something wrong with our economy as a whole and things are really going south, well, then I always keep my put options on and my triple leverage shorts and my short income ETFs on. We have about 500,000 of margin debt right now, margin leverage. But I was just saying before I got on this podcast, I'm just reiterating it to myself as the market's falling right now. We have 100,000 short, 50,000 short. And if there was any implosion in the dollar or something like that to where, things got really, unstable, well, then the stocks would just fall, and then the index puts, go up. That's how I protect myself from anything. Honestly, if there's a problem if there's another war, if there's anything going on, then, the indexes are going to fall, and I just protect them with puts,
Mm-hmm.
Another good question. This one for Will. You guys have any new funds that are going to be released soon? It looks like it's a planted question, but it's really not. This is just for those that are watching.
Yeah, no. I mean, I suppose the answer to that is we're always trying to bring out new funds. So nothing sort of, nothing I can sort of say immediately, like, hey, next day or, next week we're launching this, that, and the other. But, it's more just staying in touch with following us on social media, et cetera. And you'll be the first to get the press releases of new launches. But I think the two things that we are very keen on at the moment are the YieldBOOST family. So that's a family of 20 funds. We're going to be launching more. We have 3 at the moment: the Tesla, the Triple Q, and the SPY. Launching more. Leverage single stocks, huge family for us as well. Launching more in that space.
Maybe as we start to close out here, Todd, we always like to ask this question as a way of kind of wrapping up the podcast. Since this is the High Conviction Podcast by GraniteShares,
Yep.
What is your highest conviction right now?
In the market or in life?
They're not the same? Come on now.
Yeah, right. They are. They are one and the same for me, actually. Yeah.
I think same with all of us, man. Same with all of us.
Yeah, absolutely. Well, I think, I'm not going to get religious on the podcast or anything, but the Bible, it does say, seek the kingdom and all things will be done unto you. I always seek indexes first, indexes with dividends first, and then all things will be taken care of in my life. I feel my family will be taken care of. Everything will be taken care of. And the thing that I have the highest conviction on right now are the indexes themselves, because they've fallen 10% to, in some cases, almost 20%. The Russell's almost down 20, I believe now. So that's where my conviction is right now, the indexes, and it always is.
Good stuff. Thank you. Yeah, a lot of good questions. And then, yeah, thank you so much for everybody to ask those questions to Todd, myself. Always really interesting. And there's a bunch there that we couldn't answer, but any that are related to the GraniteShares funds are super helpful for us to get feedback. Whether it's people asking about weekly distributions, whether it's about different asset classes, etc. It's very helpful. Like, these are all, I think, to some degree, like a moving target, and we're always trying to evolve to deliver the best investment outcomes for people. So sometimes that might mean changing a strategy a little bit based on feedback. So the feedback is important. I do value it.
Yeah, and credit to Todd for building a nice community of people that are engaging thoughtfully the way the audience is here. Todd, for those who want to track more of you, maybe talk about your YouTube channel and the Discord.
Yeah, excuse the noise outside. So you can just follow me at YouTube, Unconventional Wealth Ideas. I do have a Twitter, an X, but I'm not too active with that. Anything that I put on YouTube, I try to put it out to the other social media outlets, but I basically do all my work on YouTube, and then in my live videos in YouTube, Unconventional Wealth Ideas.
And
awesome.
of course, make sure you check out the GraniteShares Substack at graniteshares.substack.com, as well as the GraniteShares website itself.
Also, can I add one thing? Can I tell them about the trip?
Please.
So I can tell them about this trip, and that we're going to Vegas, right, next week, right? And it's going to be a big conference, and I'm really excited about that. So I'm going to be posting a lot more content related to that and the findings from that conference. And as GraniteShares releases more funds, I'm going to be doing more videos on those, so you can stay up to date with those in my channel. It should be fun next week.
Yeah, and what Todd's referring to specifically is this is the largest ETF conference actually that exists in the US. So it's a big industry event, but increasingly it's getting more important for content creators, members of the media, etc., that are covering the ETF market and covering this industry as it grows. So yeah, awesome. Looking forward to seeing you there.
Likewise, yeah.
Thank you, everybody, for watching. Again, this is the High Conviction Podcast by GraniteShares. Special thanks to Todd, of course, my friend and co-host, Mr. Will Rind, and we'll see you all in the next episode. Thanks, Todd.
Thanks for having me, guys. Take care.
Thanks, Todd.
See you soon.
Appreciate it.
Bye.
Cheers, everybody.